Hi, it's the 28th of February 2018 and welcome to our 5-minute tax update. The aim of our tax webcasts is to brief you on the most important tax developments in Cyprus. So let's set the countdown clock and start. In an effort to develop Cyprus's emerging funds industry, a number of tax bills which were under discussion for some time now were finally approved by the Council of Ministers for submission to Parliament. The main provisions of the tax bills are the abolishment of the special defence contribution reduced rate of 3% on the deemed dividend distributions of UCITS and AIFs, the permanent establishment exemption for foreign investors in funds established either as common funds or partnerships, and a special tax rate of 8% on the carried interest earned by fund managers. In addition to the above tax benefits, the bill also provides for the electronic submission of a return by the manager of the common fund or partnership for the purpose of reporting to the tax authorities the income of the unit holders for funds under their management. We understand that the proposed bill aims at encouraging the establishment of UCITS and AIFs in Cyprus and to attract senior management to move and become tax residents in Cyprus, with all the positive consequences for the economy. We will update you on this topic once the bills are voted into law. We will now look at some circulars issued recently by the Tax Department. Circular 16 provides for clarifications on the calculation of the 10% penalty imposed on the difference between the provisional tax declaration and the final tax liability. The Commissioner of Taxation has finally accepted the position of ICPAC, which has been under discussion for many years now, that the 10% additional tax should be calculated on the balance of the tax payable after the deduction of any foreign tax credits. This makes much more sense, and it is clearly what the intention of the law was. Circular 17 provides a clarification on previous Circular 4 of 2017 regarding the income that qualifies for the 50% exemption provided under Section 823 of the Income Tax Law. The new circular explicitly provides that when a person performs duties of an executive director and also participates in the company's board of directors as a non-executive director, then the remuneration resulting from this participation should be included in the income from employment for the purpose of the 50% exemption. Although the circular refers to the director acting in both an executive and non-executive capacity, we understand that the intention was to include the director fees received by non-executive directors. This is a welcome clarification, as the practice of some district offices in the past was not to include such income in the 50% exemption. Circular 18 interprets Section 31B of the Assessment and Collection of Taxes Law, which provides for the obligation to maintain books and records and to prepare audited financial statements by individuals with an annual turnover of more than 70,000 euros. The circular clarifies that the threshold of the 70,000 euros will apply only to those individuals carrying on a business. In such a case, the level of the business turnover will be irrelevant, and an obligation to maintain proper books and records which must be audited will arise if the individual has combined income from the business, rents, interest and dividends which exceed in total the amount of the 70,000 euros. Where an individual does not exercise a business activity, for example, an employee, but has income from rents, interest or dividends, there will be no obligation to maintain books and records which must be audited irrespective of the total amount of the income. We believe this is in the right direction, but to be honest, we were expecting that the obligation to maintain proper books and records which must be audited should have been concentrated on the turnover of the business and not on the total income of the individual. Let's now move on to some announcements made by the Tax Department. The Tax Department has recently published the 10-year government bond yields for the following countries as at 31 of December 2017 for the purpose of calculating the NID. On the 9th of February, the Tax Department announced that it will stop processing pay-as-you-earn payments that do not carry interest and penalties at the Tax Department service desks. As from the 1st of March, these payments will need to be made electronically via JCC. For cases where the tax does carry interest and penalties, the payments must still be made at the respective district offices. We will now close off today's tax update with a brief reminder of the deadlines coming up. 31st of March is the deadline for the electronic submission of income tax returns for individuals and companies preparing audited financial statements for the tax year 2016. It is also the deadline for the submission of the returns and payment of the first installment of the special tax levy by credit institutions for 2018. This concludes our tax updates for this month. Thank you for watching.